Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Mike Wilson of Morgan Stanley is bullish, writing, "We're bullish into 26. Through the near term, setup is not without risks. These include tariff-related inflation." Mike joins us now for more. Mike, good morning. Good to see you. You list a lot of reasons to be constructive here. Just go through those reasons for us this morning.
Yeah, I mean, the reasons really haven't changed. I mean, we've been very constructive since May when we did our mid-year update. And I think the main thing to take away from our outlook that's maybe different than others, I think we came into the year feeling the first half would be tricky, second half would be better. And that was all a function of the sequencing of the policy, right? So the policy sequencing was what we said. It's a kitchen sink the first quarter. They did the growth negative stuff first, and then it flipped very quickly in April. So the main reason we're bullish, okay, is that the earnings revision breadth, and we show this every week in our note, and it goes up every week, has exploded higher off of what was, a deep cyclical low that basically priced in a recession for the most part. So that revision breadth is guiding us to the performance that we've seen. This is, just to put it in context, okay, this increase or V-shaped recovery in earnings revision breadth is as significant as we've seen since COVID, the COVID recovery. And that was the last time that we were this far out of consensus being bullish. And it was right because of it's the data. We're data dependent. So that's the main reason. So this is not just me saying, momentum in stocks and price momentum, et cetera. That's part of it too. So what's driving that earnings revision breadth? Well, first it's the reflexivity just on people getting too bearish on the growth negative stuff. And let's not forget the AI CapEx cycle, which we came into the year feeling negative about, also bottomed in April. Okay, so those are two big drivers. The second one is a weaker dollar. Okay, weaker dollar is a big tailwind for multinational companies. Okay, and the third one now is we're starting to see operating leverage in more companies across the S&P 500. And this is a very unique view that we've had. So you know the rolling recession call that we've kind of been talking about. Well, now it looks to us like we're having a rolling recovery. Okay, and that will be further spurred by the Fed cutting rates at some point in the next year. Now, we don't know exactly when they're going to start, but I think it's fair to say that they're not going to be raising rates. So this 3-year, what I would call soft recession that we've been living through now, we're sort of coming through that. And we're getting more visibility on that. That's why we're more constructive on the next year. Now, in the next 3 months, I do think that some of the things that people have been worried about could start to play through earnings. For example, we can see cost of goods sold increase because of the tariff. The inventory now is flowing through the cost of goods sold. We can see the back end of the treasury market start to back up again because of the supply that we know is coming. And then, of course, we still have to deal with just the sort of concern around inflation and how does that play through and how does the Fed respond to that. So there are risks out there. We're not saying there's no risks. And remember, the market trades 6 months in advance. So that's what's happened. The market has figured this out. It's gotten ahead of it, and we've priced a lot of good news.
How much is this entirely tech-driven versus a broad-based kind of revisions increase and recovery, given some of the mixed guidance that we're getting this morning from a number of companies, particularly those that are consumer-facing? That's
right. Well, it still remains mixed because we're still in this rolling recovery, right? So it's not everything at once. Tech and the Mag 7 are leading, but we're seeing also other groups, industrials, financials, okay, software, which has been in a soft recession for the last couple of years. We are seeing a broadening out for the Mag 7. So it's not where we need to be to say, we're going to move into small cap stocks, we're going to move into the low quality parts of the market. We're still staying up that curve. However, it's starting to progress, just like the rolling recession saw a degradation that was not all at once, but kind of more piecemeal.
So during the rolling recession, we saw gains of about 20% on the S&P 500 for a couple consecutive years. Could you see gains of 20% or more during a rolling recovery? Does it matter if you're in a rolling recession or rolling recovery in terms of the returns?
What I would hope is that we would see areas that have been lagging start to participate more. And that's sort of our view on 26, right? And that's sort of starting to happen now. I mean, industrials has been the best performing sector year to date. It's been our top pick for the right reasons, for the reasons that we've been citing, which is earnings there are starting to look better. Now, let's not forget the tax bill, which I didn't even mention earlier. This is a massive, tailwind for cash earnings for U.S. companies. I mean, to the tune of 5 to 10% increase. So that's real money going into the pockets of companies. They're now allocating capital, not the government. And I think everybody would agree that that's probably a better outcome.
Do you think U.S. exceptionalism is back? Is everyone else signing up to that?
Well, what I would say is that maybe U.S. exceptionalism has been missing. Okay, so now, I mean, no one wants to admit this, but the direction we're going in now, it looks like we are going to see better participation across the economy. We've been waiting for this. We've been waiting for this for 2 or 3 years. You know, we've been kind of back and forth, sometimes bullish, sometimes bearish, trying to pick stocks. And this is the first time I can say that I can now see the path of this transition where we're actually starting to rotate into more of an early cycle recovery.
Let me give you some more space to do this because it's important. The strategy of the White House and the rebalancing that you envision a year out, 2 years out, 3 years out, what is it you see?
Well, the rebalancing is both global and domestic. So the global rebalancing is obvious. They're trying to reduce our current account deficit, the trade negotiations are along those lines. And I think that's right. I think that's a good strategy, getting more manufacturing potentially in-house or domestically. In the domestic rebalancing, it's really, instead of just having the 1%, right, it's, Main Street over Wall Street. I mean, people say, well, that doesn't sound like that's working right now. But the idea here is you get lending through the regional banking sector. You get lending, smaller banks lending to small businesses, to individuals, get rates down at the back end. Okay, that will liberate actually the domestic, the sort of the middle part of the economy.
Where do you then place this idea that tariffs are pretty regressive? This idea that lower income individuals bear the brunt of it because it's essentially a sales tax on them, and you're already seeing companies really grapple with what that means for demand, particularly in the travel and leisure space. How do you square that with the sort of broad-based dynamism that you're talking about?
So I think it's very simple in the sense that you have to think, okay, what do you have to think about? What are the tariffs trying to achieve? My view has always been that this is going to end up being an import tax. Now, I would have said, 2 weeks ago, this is a 10%, it's going to end up at a 10% import tax that's going to be shared between exporter, importer, and consumer. And the market will determine, okay, who can absorb those tariffs. Exporter will decide, hey, we got a discount because we're going to lose volume. Importer will say, we can't pass it on, we're going to eat some of that. And the companies that have pricing power will pass it through. Okay, now we believe that the consumer areas have less pricing power. So I would argue that the pricing power is going to be more probably in the industrial space, probably more in the, sort of the value-added supply chain. So then what do they do on the other side? Oh, they do a tax cut for the companies. So it's just basically saying we're going to tax this chain here, which is going to be a shared tax, but then we're going to actually give that away to corporations who can then reinvest and actually get the economy moving. It is a capitalist type of approach. Now, I don't know if it's going to work perfectly, but I like the direction of it. From an investor standpoint, I love this.
Kevin Gordon of Charles Schwab has a view. In arguably the biggest economic data week of the year, it all comes down to labour. Solid labour data will matter most for markets. Kevin joins us now for more. Kevin, good morning. It's good to see you.
Nice to see you.
Difficult morning?
Yeah.
Without a doubt. But we'll make some space to talk about financial markets. Let's talk about why the data for you is so important this week when we've got so many earnings elsewhere.
Yeah, well, I think I would wrap earnings in with the broader economic data, especially on the labor front, because the real mechanism that we're looking for in trying to see and assess with trade and tariffs is if any of that starts to take a big bite out of hiring. When you think about companies' largest costs being labor, if that's where they turn to, if they face a significant increase in costs, and if that's ultimately what brings the broader labor market to a weaker spot. So far, not the case. And I think even with the June jobs report, even if you get a reversal in some of those, I'll call them blips that were in there in terms of what accounted for most of the hiring at the state and local level, at the education level, the fact that the unemployment rate went down because you had this significant drop in the labor force, even if some of that unwinds a little bit, you can still be in a pretty solid spot for July. So really it turns to that back half of the year where you start to see, if at all, if there are impacts from tariffs, if they're going to start biting, that's where you really start to see it.
One of the reasons why I've been more excited for earnings than I have been for the economic data is because every time an economic data point comes out, I get 15 different interpretations and people point to different aspects of the numbers to justify why they have those opinions. Why do you feel like we're getting better data from the overall government issued numbers rather than Merck laying off workers today because of efficiencies. A number of big corporations not hiring entry-level staff because they can just get AI to do it.
Well, it's interesting. In some ways, we've sort of seen this movie before, where at least in the post-pandemic cycle, and I was thinking back to, the conversation you guys had with Mike Wilson on the last hour, talking about how, we had the same view around rolling recessions, being in certain pockets of the economy, especially manufacturing versus services over the past several years. Embedded in that were a lot of these sort of idiosyncratic company-specific stories where there were significant layoffs or there were significant cuts to guidance, but that didn't filter through to the broader economy. It didn't really rise up. So to some extent, you're seeing that again now. And I would argue, actually, one of the reasons that we've seen such a sort of incredible recovery in the market is because what's been leading have been industries, not necessarily at the 11 sector level. If you look at the 25 industry level, industries with the strongest margins have been leading. So those are the ones that can probably withstand that tariff shock a lot more, or they're further away from the epicenter of the tariffs. So you think the banks are almost the perfect example of that. And this earnings season, I would almost put the banks and the autos on opposite sides of the spectrum, looking at where the tariff pressure has shown up. You're not really seeing it at all in financials because you probably won't, given its services dominated, but you're definitely seeing it in an area like autos. But that's a small share of the market.
You sound a lot more skeptical than Mike Wilson of Morgan Stanley, who came on and said we had been dealing with a rolling recession for 3 years, and now we seem to be dealing with a rolling recovery, a rolling bull market. Why? Why are you not convinced?
Well, it's not as much that I'm not convinced. I just think that when you listen to what companies have been saying around pricing and what their response is going to be to tariffs in particular and the CapEx slowdown that we have seen, at least in CapEx intentions, even though some of the regional Fed surveys, which is sort of the best gauge that we have right now in terms of where confidence, can be turning on a dime because they come out before the ISM, headline indexes have been improving, but those underlying CapEx components haven't been improving as sharply, and in some cases they've actually been turning lower. And in some ways, this all really comes down to what happens in the business investment channel, because that tends to drive, employment gains, which tends to drive consumer spending, that drives overall productivity. So that's really what we've become most focused on. So it's not that I think that the recovery is completely stunted, because our view from a tariff standpoint, and we have to remember that pre-April 2nd, we were not in a zero tariff world. I mean, the market was still digesting that we were going to get tariffs going up relatively, significantly. So if we're going to go into a tariff world, and what we've been hearing from our clients who are facing this in terms of having small businesses is just tell us what the rate is and don't change it. Tell us what the rules of the game are, and then we'll be able to play. So if you can get past that, which arguably we're coming to that point, whether it's this Friday or not, or August 12th or not, you're getting closer to that point, which I think is a pretty important needle mover for the market and for the economy.
We're in the middle of that process right now. What started before April 2nd, though, was this allocation abroad to international equities. Is that just a moment in time or an ongoing story? How do you feel about European stocks right now following the agreement over the weekend?
I mean, we're relatively constructive because I think, well, first of all, from our perspective from our clients, nearly 40 million people who for many, many years have become very accustomed to just the U.S. dominant trend, really being the ruling trend, for good reason. But I think that when the international versus U.S. or, U.S. versus ex-U.S. argument is often talked about or discussed, it's framed in this context of all or nothing. And it's, just dump U.S. at the expense of everything else. And of course, that's never how this works for any kind of balanced portfolio. So it's really a matter of looking at what has become maybe a little bit of an improved opportunity set relative to what was. So if you're just looking at Europe, for example, relative to what was, clearly things have improved. Even the internals of the DAX, those have been much stronger this year relative to the S&P. At one point, you got to almost a third of members in that index making a new 52-week high. We have not gotten there on the S&P 500. So there are still relatively healthy internals when you compare it to the U.S., but I wouldn't look at it at all as some sort of all or nothing trade.
To be fair to people who have been long exclusive with the U.S. for the last decade, there have been many, many good reasons to have that trade on. I think they still face the same question. When I buy America, I know what I'm buying. When I buy Europe, what do I own? What am I buying?
Well, the sector bias, I think, is really important there because, when you're in the U.S., I mean, the tech-centric nature of this market now, not just tech, the sector, but tech and tech adjacent parts of it. I mean, you're getting to half, and in some cases more than half of the index. Plus, tech has become more of this cyclical beast, in addition to being a growth beast as well. So I think that that's a really important, certainly has been an important driver of outperformance over the past several years. But when you compare that to Europe, if it's a little bit more financial centric in certain countries, or if it's a little bit more, auto and manufacturing centric, if you don't get that important cyclical upswing, then then it's going to be really tough to outperform.
What is it you always say?
Luxury and weight loss.
That's right.
And right now, weight loss is kind of, on the back foot, evidently, with Novo. So
luxury too.
Exactly. So there you go. Yeah. Although it's different between Hermes and LVMH. It seems like a totally different situation.
What's gone wrong with luxury?
Yeah, you would know.
Well, it is bifurcated. I mean, I'm not a luxury analyst, but it's
in a way.
Yeah, I think that maybe I'll just leave it at that. Okay. I don't know.
Sensible. All right. Keep you out of trouble. Kevin, thank you.
Thanks,
good to see you.
Nice
thank you, sir. Kevin Gordon there of Charles Schwab. We get some more data through the week. The big one on Friday, payrolls Friday, just around the corner. Check this out. It's not a typo. This is what the graphic is meant to look like. Stephen Stanley of Santander, with a bearish forecast for Friday, he is looking for 0 jobs to be added, citing a quote, a reversal of the outside increase in government education jobs in June, as well as tariff-related uncertainty and a soft market for college graduates and students. Stephen joins us now for more. Stephen, good morning.
Good morning.
If you could flip this week and payrolls Friday was Wednesday and the Fed was Friday, if they had that information and it was 0, would they be cutting?
Probably not this week, but I think it would certainly nudge them in that direction. As I mentioned, the biggest piece of the weakness for me is in the government sector, and I think that's something the Fed would probably want to look through. I mean, remember, government employment was up over 70,000 in June, so this is just kind of a reversal of that. But private sector, we were in the 70s in June. I have it at 55 in July. If you go back to last year, we had 14 consecutive months of payrolls being up at least 118,000 through May, and then June, July, and August were all double digits. And I think part of what's going on there is we have a very soft job market for college grads and college students looking for summer jobs. The seasonals assume a certain amount of hiring in the summer, and we're getting less. And so I think we're likely to see a repeat of that this year, with a little bit of weakness on the private side in the summer and then hopefully normalizing again in the fall.
Can we just stay on government jobs? If we're supposedly meant to look through the weakness in government jobs, shouldn't we have looked through the strength as well?
Well, that's a good point, and I would say that definitely would.
The reason I bring that up for obvious reasons, as you know.
Government employment was very strong for a long time, and then if you remember early this year, everybody was getting very upset about the possibility of huge layoffs in federal government jobs, which have kind of we've had negative numbers there, but it hasn't been enough to really move the needle a lot. At the end of the day, I think the Fed is not ignoring the government sector when it comes to jobs, but it certainly gets a lesser weight than the private sector.
There's nothing inflationary in your projection. It doesn't feel like this labor market is predictive of some sort of inflationary spiral on the heels of tariffs. So why shouldn't the Fed be cutting to potentially provide a little bit more support, especially for entry-level students?
Yeah, well, I mean, the inflation concern has nothing to do with labor costs, for once, right? This is all about the possibility, from the Fed's perspective, that you get a one-off increase in prices from tariffs, and then that somehow morphs into a more sustained increase in prices. I understand the Fed's reticence to accept the textbook view that tariffs are a one-off, right? Because we had 2021, they said transitory, and it wasn't. And you can understand they're once burned, twice shy on that. But I think this is an unusual instance in which labor costs are really not a big factor in the inflation story.
Just to build on that, there is a theory that you can't get some sort of inflationary spiral unless consumers have the ability to pay for it. Unless they can absorb prices continuing to go up, you are going to see a one-time price shock. Is that transmission mechanism broken this time?
Well, I think that's the biggest difference between 2021 and 2025. I mean, in 2021, households were flush from all the money that had been distributed by the government during COVID, and I think that helped to kind of perpetuate that inflationary cycle. We don't have that this time around. A tariff increase, to the extent that it gets passed through to consumer prices, is a loss of purchasing power for households. So I do think we'll see relatively soft consumer spending as those price increases filter through.
What do you expect to hear from Chairman Powell tomorrow?
Well, I think it's a really interesting juncture for the Fed because I think early in the year, the tariff thing hit, and the story at the Fed was, we're going to sit back and let's watch this play out. We're not going to do anything. We're not going to engage. The problem is that this was certainly my original thought, that the price increases and the economic impacts would cycle through within 3 or 4 months and the Fed would be able to re-engage. Now it looks like it's going to drag on for a long time. You've got Bostic and others at the Fed now saying these price increases aren't going to be fully in place until sometime next year. So the game plan is changing. And I think I'm very interested to hear exactly what the Fed is thinking in terms of what do they need to see. Because if they're just waiting for the tariff effects to be totally through, they're going to be sitting on their hands for a year. They can't do that, right? So I think it'll be, even though they're not going to move tomorrow, it's going to be a very interesting meeting.
How divided is this FOMC going to be by the time we get to September?
It could be very divided. I mean, look at the June dots. We had 9 FOMC participants who wanted to go twice this year and 7 who wanted to go not at all, and a few, kind of in the middle. So that's pretty divided.
It's going to get messier too, because by the time we get to September, we might have a decent idea of who the Fed chair is going to be as well. So you face this odd situation where you have division on the committee, and maybe the forward guidance that Chairman Powell starts to offer for 2026 kind of becomes irrelevant because you start focusing on a different character. What does that mean for market pricing? And who to listen to, who to ignore, and how we're going to be guided into 26?
Well, it's just, as you say, it's just a lot of uncertainty, right? So the longer the process drags out, and the closer we get to May of next year, I suspect, to the extent that we don't know who the next Fed chair is going to be, the markets are going to be speculating and going back and forth depending on who, the latest leak of who's in the running or whatever. If we get a name early, and the markets conclude, okay, this person is going to get passed through the Senate and everything, this is going to be the person, then it does create a little bit of uncertainty around, as you say, does forward guidance from the current FOMC matter? I mean, you've got 19 people on the committee, you're only talking about necessarily replacing one. So maybe the committee, the nature of the debate changes, maybe it doesn't.
Just before you go, how much pushback have you had over the zero?
A lot of curiosity. I don't know that I would say there's been a lot of pushback, but as you can imagine, a lot of clients are very interested in getting some idea of the reasoning. When
that number drops at 8:30 on Friday, I think we'll all be thinking of you. Stephen Stanley
of
Santander.
Fingers crossed.
We hope you're right. We'll see.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.